Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Uber stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 163 billion market cap. They're trading at $78 a share, and they have 2.1 billion shares outstanding. Uber provides ride-hailing services, food delivery, and freight transport. It operates in 70 countries across 10,500 cities. They are the largest ride-sharing company in the world with over 150 million active users and 6 million active drivers. It makes 28 million trips per day. Since their inception in 2010, it has made 47 billion trips. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is almost identically opposite 2020 and the trailing 12 months. Negative 3.3 billion in 2020, positive 3.3 billion in the trailing 12 months. It's only off 1 million. But that's a great improvement, a big negative to a big positive. Their free cash flow grew 760% from 2020 to the trailing 12 months. They finally have a decent free cash flow margin, 9%. Free cash flow margin is free cash flow over revenue. It's what percent of your revenue you convert to free cash flow. They converted 9% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had big negatives every year until the trailing 12 months, positive 2.2 billion. Their net profit margin is 6%, which means they converted 6% of their revenue into profit in the trailing 12 months. Revenue is a sales for the company, and that grows a ton from 11 billion up to 37 billion. They grew 83% from 2021 to 2022. Amazing growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 168 billion. We discounted those numbers back to today using the weighted average cost of capital. Their WACC is 9%. And we get a value of the company of $144 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of $69. They're trading at $78, so they're trading at a 13% premium. It's a sell according to the model. Look how much their free cash flow is projected to grow in the next few years, from 3.4 billion up to over 10 billion by 2026. And I do think they're going to hit these levels. Even though I say the stock is a sell, I would probably buy it. I think they're at a good point now. I feel comfortable with their business model. I feel comfortable they can be profitable. There are 244 companies in the same industry as Uber, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 223 million in CapEx. These are investments in property, plant, and equipment. I'm not sure what their CapEx spend is, because I know they don't buy cars. They may have capitalized some of the software they acquired from other companies. They also may have bought real estate because they have offices for their staff. Like their corporate staff, for instance, they have accountants, lawyers, the CEO. Debt to equity ratio is decent at 1.0. That's better than the average, worse than the median. That means for every dollar of equity, they have $1 of debt. They don't pay a dividend, but I'm pretty sure they're going to start paying one this year. They have a nice amount of free cash flow, 3.4 billion. They just started generating positive free cash flow, so this number is going to start ballooning. They rank third in market cap, a little ahead of ServiceNow, a bit behind Intuit, a lot behind Salesforce. Price to book is stock price over book value per share. They're worse than the median and average. PE is stock price over earnings per share. They're between the median and average. Price to free cash flow is stock price over free cash flow per share, also between the median and average. Price to sales is stock price over sales per share, between the median and average. They generate the most revenue out of any company in this industry. but their revenue isn't great revenue. It's good revenue. What I mean by that is they have to share a lot of their revenue with their drivers. A company like Salesforce doesn't share as much revenue. They can scale much easier. That was my main deterrent with Uber, is they have to give part of their revenue to the driver. So in terms of scaling, you can't infinitely scale like you could a software company, because there's not an infinite amount of drivers out there. And you have to find drivers, and you have to rely on them. And then you have to deal with the headaches that they want insurance or they want higher pay. When you're a company like Intuit, you could make software and scale it very easily with just a handful of employees. You don't need to hire a new employee every time somebody uses your product, where you do need to have an employee every time you drive somebody. And their revenue is growing a lot. Their 5-year annual revenue growth rate is 29%. Shopify, 46%. But the average in the industry is pretty high, 18%. Salesforce is still growing a lot, 22%. Intuit, 19%. Let's take a look at their most recent 10Q. This is as of 9/30/2023. This column is the third quarter of 2023. This is the third quarter of 2022. This column is the first 3 quarters of 2023. This column is the first 3 quarters of 2022. They kind of do it opposite of other companies. Other companies would have 2023 in this column and 2022 in this column. It kind of threw me off for a second. Revenue in the third quarter is $9.3 billion. Let's get a breakdown of that number. Here's a $9.3 billion, which is up 11% from last year, $8.3 billion. They break down the $9.3 billion into 3 categories. Mobility, $5.1 billion. Mobility is like when they carry passengers. Then you have delivery revenue, $2.9 billion, like Uber Eats. Freight revenue, $1.3 billion. That's the only one that's down. Here they give a nice breakdown of the 3 different revenue segments. Mobility products connect consumers with drivers who provide rides in a variety of vehicles, such as cars, rickshaws, remember on Seinfeld, motorbikes, minibuses, or taxis. Their delivery revenue allows consumers to search for and discover local restaurants, order a meal. It also provides grocery, alcohol, and convenience store delivery. Freight connects carriers with shippers on our platform and gives carriers upfront, transparent pricing and the ability to book a shipment. Freight also includes transportation management and other logistics services offerings. So if you're a regular consumer like me, you probably never heard of freight before. Mobility revenue is up the most, 33%. Delivery is up 6%. Freight is down 27%. Here's a breakdown of revenue by location. US and Canada, that's flat, $5 billion, same as last year. Latin America is $640 million, that's up from $518 million. EMEA, $2.6 billion, up from $1.9 billion. APAC, $1.1 billion, up from $900 million. Below revenue is the cost of revenue. These are all the expenses tied to generating the revenue. A big portion of that is the cut the driver gets. Cost of revenue is $5.6 billion. Operations and support, $700 million. Marketing, $900 million. That's down quite a bit from last year of $1.2 billion. R&D, $800 million. G&A, $646 million. Depreciation and amortization, $200 million. So their expenses are flat from last year. $8.9 billion. Last year, $8.8 billion. But their revenue is up 11%. Revenue up 11%, up almost $900 million with the same amount of expenses. That gives them operating income of $390 million, as opposed to an operating loss of $500 million. They're becoming more efficient, which is what you like to see. So they have a net profit of $220 million for the quarter. Last year, they had a net loss of $1.2 billion. Big improvement. Earnings per share of 11 cents compared to a loss per share of 61 cents. They are adding shares, though. They have a little over 2 billion shares outstanding. Last year, a little under 2 billion. But that's fine, as long as their EPS is improving, which it is quite a bit. Let's take a look at the balance sheet. Current assets of $10.7 billion. At the end of 2022, it was $9.2 billion. Current liabilities of $9.4 billion. So their current ratio is a little above 1. Lots of cash, $4.4 billion. $700 million of short-term investments. Short-term investments, U.S. government bonds, $318 million, commercial paper, $350 million, corporate bonds, $53 million, and CDs, $3 million. All really safe, high liquid investments. They have $800 million of restricted cash. Their largest asset is goodwill, $8.1 billion. Goodwill is the premium you pay when you acquire another company. Here's a breakdown of their goodwill. Of the companies they acquired, $2.3 billion was from mobility, $4.4 billion for delivery, $1.4 billion from freight. They acquired the giant freight company Transplace. That was in 2000. They paid $2.25 billion. Drizzly is a really large alcohol delivery service. They paid $1.1 billion for that. That was 3 years ago in February 2021. Careem is known as the Everything app because they deliver so many different things. They're based in the UAE, United Arab Emirates. They pay $3.1 billion for that company. They have a total of $36 billion of assets, $32 billion at the end of 2022. Liabilities, $25 billion. They have $6.6 billion of accrued liabilities. An accrued liability is an expense the company incurs but hasn't paid it yet. They give a breakdown of the $6.6 billion. $1.6 billion is legal expenses. $1.9 billion and $550 million are expenses due to their drivers or employees. $550 million of income taxes and $1.9 billion of other. They have $9.2 billion of long-term debt. Here's a breakdown of the long-term debt. $2.5 billion is due in 2030. That has a high interest rate of 8.3%. $1 billion due in 2025, an interest rate of 7.7%. $1.5 billion due in 2026, 8.1% interest. So they pay a high interest rate on their debt. 7.77. This is low, 4.7. That's $1.5 billion. Usually when debt is due, the company doesn't pay down the debt. They refinance it. They take on new debt to pay the old debt. That's what this is, 2030 refinance term loans, $2.5 billion. And if you want to know what that is, they explain it right here. In March 2023, they entered into 2 refinancing transactions pursuant to an amendment to the 2016 Senior Secured Term Loan Agreement. They borrowed $1.75 billion, the first closing. The proceeds were used to repay all outstanding 2025 refinance term loan of $1.4 billion and $317 million of the outstanding 2027 refinance term loan. So they're refinancing a previous loan. It's like when you refinance your home loan, although it's a little different because people usually refinance to get a lower rate. They're refinancing because the debt is due. On March 2023, we entered into the second refinancing transaction. They borrowed $761 million, second closing. The proceeds were used to repay in full all outstanding 2027 refinance term loan. It sounds like the debt wasn't due because if it was 2027 debt, why did they refinance it? Well, it's possible there was a trigger that forced them to repay the loan, like a failed covenant. When you take their assets minus their liabilities, you get their equity of $10.1 billion. That's the value of the company according to the balance sheet. They raised $42 billion from selling their business. They lost $32 billion from running their business because they just started generating positive net income. So in a few years, this negative should be a positive. Let's take a look at their statement of cash flows. This is for the trailing 9 months. And the first section is operating cash flow. That's how much cash a company generates from its operational business. In 2022, it was $900 million. 2023, $2.8 billion. A big improvement. The way you calculate operating cash flow, you start with your net income of $456 million. You see this 456? You'll find that on the income statement. This is their income statement for the first 9 months of 2023. And you see the net income of $456 million. Net income is revenue minus expenses. It's their accounting profit. Let's go back to the statement of cash flows. So to calculate operating cash flow, we start with the net income number. We add back the non-cash items on the income statement. The big one was $1.5 billion of stock-based compensation. We adjust for changes in working capital. So that's how they get $2.8 billion of cash flow. This is a better indicator of how the company's doing than net income because this is actual cash. In their investing section, they had a cash outflow of $2.4 billion, but most of that was from the purchase of marketable securities. So I would just ignore that. They spent $168 million of PP&E. Last year, $193 million. in their financing section, they added $1.1 billion from a term loan. They repaid $1.1 billion of a term loan. Remember that UAE company they acquired, Kareem? It looks like they had to pay back $25 million on a note, because when they acquire those companies, they also acquire the debt. They paid $118 million on finance leases. They sold $85 million of stock to their employees, so that's a cash inflow. So in their financing section, they had a cash outflow of $141 million. Let's look at the company on Simply Wall Street. Its last price, 78, 162 billion market cap, up 13% in the past week, up a really impressive 125% in the past year. Let's see what they say about the company. Uber develops and operates proprietary technology applications in the US, Canada, Latin America, Europe, the Middle East, Africa, and Asia, excluding China and Southeast Asia. Uber spent a lot of money trying to get into China, and they failed miserably. It was a big cash burn. They couldn't compete with Didi, the other ride-sharing company. Didi is by far the largest ride-hailing company in China. They have 550 million users and tens of millions of drivers. Let's go back to Uber. They operate through three segments: mobility, delivery, and freight. The mobility segment connects consumers with a range of transportation modalities, such as ride sharing, car sharing, micro-mobility, rentals, public transit, taxis, and other modalities. It also offers riders a variety of vehicle types, as well as partnership products and advertising services. The delivery segment allows people to search and discover restaurants for grocery, alcohol, convenience, and other retail establishments. You can order a meal or other items. This also includes Uber Direct, a white label delivery as a service for retailers and restaurants, as well as advertising. The freight segment manages transportation and logistics, which connects shippers and carriers. And this provides an on-demand platform to automate logistics, end-to-end transactions for small and medium-sized businesses to large global enterprises. They were formerly known as Uber Cab and changed their name to Uber Technologies in 2011. They were founded in 2009, headquartered in San Francisco, California. Simply Wall Street's valuation is $128. They say the stock is 39% undervalued. Here's the stock price since 2020. It looks like it IPO'd at around 30 maybe. It's hard to tell on this chart. Then a few months after IPO was COVID, the stock went from 40 to 20. Then it ran back up to its all-time high at that point to a little over 60. And then the stock started tanking over the next year, year and a half. It fell to 20 again. But from mid-2022 to current, it's only been going up. You can see this year alone, the stock has crushed it. It went from 60 to 80. 48 analysts priced this stock at $84. Their revenue forecast for 2023 is $37 billion, 2024 $43 billion, 2025 $50 billion, and 2026 $58 billion. I definitely think they will hit these targets. 2023 free cash flow $3.4 billion. 2024 $5.3 billion, 2025 $7 billion, 2026 $8.7 billion. Here's their debt since 2016. It was $3 billion, but they do lots of acquisitions, so they ran their debt up to $9.5 billion in 2021, and it's been pretty much flat since then. Equity is always pretty strong. It's usually higher than their debt. Right now, it's a little bit higher. So according to Simply Wall Street, their debt-to-equity ratio is 76%. But this green line is their cash. They have lots of cash on their balance sheet. So if they wanted to, they could pay off a big chunk of their debt. The CEO's annual salary in 2018 was $1,336,000 in 2020. He took a pretty big pay cut, back up to $1 million. And Dara's total compensation is $24 million. Dara is Persian, and he was previously the CEO of Expedia. He's been CEO over 6 years. In the past 12 months, there's been only insider sells, mostly by Jill Hazelbaker. She's a pretty powerful woman. She was communications director for John McCain's presidential campaign. She used to work for Google, Now she's a senior vice president of marketing at Uber. 83% of the company is held by institutions and 17% by the general public. Vanguard is the biggest shareholder at 8%, then BlackRock, Fidelity Capital Research, Morgan Stanley, T. Rowe Price, BNY Mellon, UBS, Invesco. Their employee count has gone up from 22,000 in 2018 to 30,000 currently. And the ticker trades on the New York Stock Exchange, London Stock Exchange, Börse Stuttgart, Wiener Börse, Deutsche Börse, Xetra, Mexican Bolsa, Euro TLX, Swiss, the Colombia Bolsa, BATS Europe, Sao Paulo Bolsa, Buenos Aires, the NEO, and Börse München. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.